Most people steer clear of the stock market because they think it's a risky gamble with their money. They've heard horror stories about people losing everything overnight and assume the same fate awaits them. But what if everything you've been told about stock market risk is wrong? What if the very thing keeping you from building wealth is nothing more than a myth? The truth is, when you understand how the stock market actually works, it becomes one of the most reliable wealth-building tools available. It's time to separate fact from fiction and discover why the stock market isn't nearly as dangerous as you think. The long-term reality of market returns. Let's start with the numbers that nobody talks about. Since 1928, the stock market has delivered an average annual return of around 10%. That's nearly a century of data showing consistent upward momentum. Over the past 100 years, this pattern has held remarkably steady, producing returns that have consistently outpaced inflation and created generational wealth for millions of investors. The problem is that most people focus on short-term volatility instead of long-term trends. Yes, the market goes up and down from day to day, week to week, and even year to year. But when you zoom out and look at decades rather than days, a completely different picture emerges. Research shows that while one-year periods can swing wildly from negative 37% to positive 53%, when you examine 20-year periods, the range tightens dramatically to between 0.5 and 13.2% annually. Even more striking is this fact: the stock market has never declined over any 20-year period in history, not once. This isn't speculation or theory. It's historical data spanning generations of economic cycles, recessions, wars, and crises. The market has weathered every storm and continued its upward trajectory over time. When you invest for the long term, you're not gambling on short-term predictions. You're betting on the fundamental growth of businesses and the economy itself. Companies innovate, expand, and generate profits. These profits drive stock prices higher over time. That's not luck or chance. It's the natural result of economic progress and human ingenuity working together. Why diversification changes everything. Here's where most people go wrong with stock market investing. They either put all their money into a single stock hoping to strike it rich, or they avoid investing altogether because they're afraid of losing everything. Both approaches miss the most powerful risk reduction tool available: diversification. Think about it this way. If you invest in just one company, you're exposed to every possible risk that company faces. Bad management decisions, increased competition, technological disruption, regulatory changes, or industry downturns can wipe out your investment. That's genuinely risky. But when you spread your investment across hundreds or thousands of companies through diversified funds, something remarkable happens. The risk from any single company becomes nearly irrelevant to your overall portfolio. Research has demonstrated that only 4% of all publicly traded companies are responsible for the market's positive returns over time. The remaining 96% merely match risk-free investments. This sounds alarming until you realize what it means. You don't need to pick winners. You just need to own enough companies so that you automatically capture those exceptional performers. Diversification works because different investments respond differently to market conditions. When technology stocks struggle, healthcare might thrive. When domestic markets falter, international investments may excel. When stocks decline, bonds often provide stability. By holding a mix of assets across different sectors, company sizes, and geographic regions, you create a portfolio that can weather almost any economic storm. The beauty of modern investing is that diversification has never been easier or cheaper. Index funds and exchange-traded funds allow anyone to own thousands of companies with a single investment. You don't need to be wealthy or have special knowledge. You just need to understand that spreading your investments reduces risk far more effectively than any other strategy available. Time in the market beats timing the market. One of the biggest myths about stock market investing is that success depends on knowing when to buy and when to sell. People spend countless hours trying to predict market movements, waiting for the perfect entry point, or panicking during downturns and selling at the worst possible time. The evidence overwhelmingly shows this approach fails. Even professional traders with sophisticated algorithms and years of training struggle to consistently time the market. For average investors, it's essentially impossible. Every moment you spend waiting for the perfect time to invest is time your money isn't growing. Consider what happened during the 2020 pandemic crash. Markets plunged as fear gripped investors worldwide. Many people sold their holdings, convinced the economy would collapse. But those who stayed invested or even bought more during the downturn saw remarkable recoveries. Companies that dropped sharply in March doubled within a year. The investors who panicked locked in their losses. Those who remained patient earned substantial returns. This pattern repeats throughout history. Short-term declines feel terrifying in the moment, but they represent temporary setbacks rather than permanent losses. The key is having the discipline to hold through volatility and let compounding work its magic. Compound growth is the secret weapon of long-term investors. When you reinvest dividends and leave your money to grow, each year's gains build on previous year's returns. A dollar invested today doesn't just grow by 10% per year. It grows by 10% in year 1, then 10% on your new, larger balance in year 2, and so on. Over decades, this creates exponential growth that turns modest investments into substantial wealth. But compounding only works if you stay invested. Every time you sell and sit on the sidelines, you interrupt the process. You miss out on the days when markets surge, and research shows that missing just the few best days each decade can cut your returns in half. Understanding real risk versus perceived risk. The stock market isn't risk-free. No investment is. But the risks most people worry about aren't the actual dangers they face. The real risk isn't losing money in a market crash. It's not building wealth at all because you stayed out of the market entirely. Consider inflation. Money sitting in savings accounts loses purchasing power every single year. If inflation runs at 3% annually and your savings earn 1% interest, you're actually losing 2% per year in real terms. Over 30 years, that adds up to a massive erosion of your wealth. Stocks, despite their volatility, have consistently outpaced inflation by a wide margin. The real return after inflation averages around 6 to 7% annually for diversified stock portfolios. That means your money doesn't just grow. It grows faster than the cost of living, allowing you to build genuine wealth over time. Another overlooked risk is being forced to sell during a downturn. This is why financial advisors emphasize having an emergency fund and only investing money you won't need for at least 5 to 10 years. When you invest with a proper time horizon and emergency cushion, temporary market declines become irrelevant. You're not forced to sell at the bottom. You can wait for the inevitable recovery. The psychological risk is also worth addressing. Watching your portfolio fluctuate can be stressful if you check it constantly, but this stress comes from focusing on short-term noise rather than long-term signal. Investors who review their portfolios quarterly or annually experience far less anxiety than those who obsess over daily movements. The market will be volatile. That's not a bug, it's a feature. Volatility is the price you pay for higher long-term returns. Many people think successful investing requires expert knowledge, constant monitoring, and quick reactions to market changes. The opposite is true. The most successful investors are often the most boring. They invest consistently, hold diversified portfolios, ignore short-term noise, and let time do the heavy lifting. You don't need to understand complex financial models or follow market news religiously. You need a simple plan, the discipline to stick with it, and the patience to let decades of compounding work in your favor. The stock market has created more wealth for ordinary people than any other investment vehicle in history. It's not reserved for the rich or the lucky. It's available to anyone willing to invest consistently and think long-term. The risk isn't in participating. The risk is in staying on the sidelines while inflation erodes your purchasing power, and you miss out on the compounding growth that could secure your financial future. Understanding that the stock market is less risky than commonly believed is the first step toward building lasting wealth.